All right, so you want to get a grip on value investing, huh? And you've got, like, the ultimate guide, The Intelligent Investor by Benjamin Graham.
Yeah, I mean, this book's basically the Bible for investors. Even Warren Buffett swears by it.
Okay, so today we're doing a deep dive into The Intelligent Investor, right? We'll try to unpack the main ideas.
And hopefully give you some, some actual takeaways that you can use. The thing about the Intelligent Investor is it stood the test of time. It's not about, like, getting rich quick.
It's not about trends.
No, it's more about building wealth slowly.
Yeah, it's a long game, right?
Yeah.
But let's be real. Sometimes that book feels like you're reading a dictionary, a financial dictionary, right? So, like, what's the big idea? What is value investing at its core?
Well, at its heart, value investing, it's basically buying stuff for less than it's actually worth.
Okay, so finding a deal.
Yeah, like finding a hidden treasure at a flea market, but for stocks.
Okay, I get that. But how do we know what something is really worth? I mean, stock prices are all over the place, right?
Yeah, and that's where Graham's idea of margin of safety comes in. So let's say you're looking at a company and you've done your research. You think it's worth, say, $100 a share,
Okay.
but you can buy it for $70. That $30 difference, that's your margin of safety.
Oh, I see. So it's like a buffer.
Exactly, like a cushion, just in case things don't go as planned.
Because they never do.
Right.
Right.
So it helps you, avoid overpaying or getting burned if the market drops suddenly.
Right, right.
Yeah.
So finding that margin of safety helps protect you. Okay, that makes sense.
It's all about managing that risk.
And this is all about the long run.
Exactly. Now that brings us to another important idea, Mr. Market.
Mr. Market.
Yeah.
Sounds like an interesting guy.
He is. He's more of a metaphor, though. Graham uses him to describe the stock market's mood swings, its emotions.
So like the ups and downs, the good days, bad days.
Yeah. Think of him as this, this kind of unpredictable character who comes to your door every day offering to buy or sell you stocks. But sometimes his prices are reasonable, and sometimes they're just crazy.
So it's like, he's got two sides, maybe more.
Exactly. And the key is you don't have to deal with him if you don't want to, especially if you think he's being irrational.
You can just walk away.
Yep. You got to remember the market is driven by fear and greed, and you can use that to your advantage if you're patient.
Oh, interesting. So Mr. Market's mood swings can actually be a good thing for an investor.
That's the idea. When Mr. Market is super pessimistic, he might sell you a great company for a steal.
Oh, so you got to look for those opportunities.
Yeah, and when he's overly optimistic, you can sell something for more than it's worth. It's like playing chess with him.
I like that. Playing chess with Mr. Market. But how do we keep our own emotions in check? I mean, it's easy to get caught up in the hype, right?
That's where discipline comes in. One of the most important things in value investing is to separate your emotions from your decisions.
So, like, not panicking when things go down.
Right. Don't get swept up in the hype. Stick to your plan and think long term. You're not buying stocks, you're buying a piece of a business.
Right. Yeah. Think like an owner, not just a trader.
Right.
Right. And I remember Graham talks about two types of investors, the defensive and the enterprising.
Mhm.
Is that where we figure out which one we are?
Yeah, it's kind of like choosing a path. One is like this quiet, scenic route. The other is more adventurous.
Ooh, I like adventurous. Tell me more about those paths.
So the defensive investor, they're all about simplicity and keeping their risk low.
Got it.
They might invest in index funds or a bunch of like blue chip stocks, kind of a set it and forget it approach.
Low maintenance, huh?
Exactly. Now, the enterprising investor, they're more hands-on. They're digging deep, researching individual companies, looking for those hidden gems that the market's missed.
Sounds a little riskier.
It can be, but it can also have bigger rewards.
So it's about finding what suits you, right?
Yeah.
Your personality, your time, how much risk you're comfortable with.
Yeah, there's no one right way. It's got to be a good fit for you.
I like that. So, okay, I'm starting to think maybe I can do this value investing thing, but let's be real. Investing always has risks, right? How do we manage that?
That's important. Graham makes a really important distinction between risk and volatility.
Wait, are those not the same thing?
Well, not really. Volatility is like the ups and downs of the market, the short-term changes. It's like riding a roller coaster, exciting, maybe a little scary, but temporary.
Okay.
But risk, the way Graham sees it, is about losing your money permanently. Think of it like driving a car with bad brakes.
That's a little more serious.
Yeah, way more serious. So a value investor, they try to avoid that big risk, not just the ups and downs.
So like looking for companies that have good fundamentals.
Exactly. Companies that are strong, profitable, and can weather the storms.
Not just like the hot new thing that everyone's talking about.
Right. You got to be more like a detective, looking
Yeah.
at all the evidence.
Okay, this is all making sense. But let's be honest. The market can be exciting. Everyone wants to get rich quick. How do we stay focused on the long game and not make, like, impulsive decisions?
Well, it's about having that psychological discipline. Graham said it best. The investor's chief problem, and even his worst enemy, is likely to be himself.
So we got to battle our own brains.
Sometimes, yeah. Emotions can make us do dumb stuff, like buying high and selling low. But we can learn to be more disciplined.
So how do we train our brains to be better investors?
Well, one important thing is to have a plan and stick to it. Write down your goals, what you're comfortable risking, and how you'll invest.
So having a plan helps you stay on track when things get crazy.
Exactly. It's like having a rule book to keep you from making those emotional decisions.
I like that. A rule book for investing. This is all super helpful, but I'm still a little intimidated. It's one thing to understand the ideas, but actually doing it feels like a whole other thing. Where do we even begin?
That's a good question, and that's what we'll talk about in the next part of our deep dive. But before we go, I want you to think about something. What are some concrete steps you can take to actually start using Graham's principles in your own investing?
Ooh, good question. I'll definitely be thinking about that. But don't worry, listeners, we'll be back soon to, really dig into how to use all this stuff. So keep thinking.
Yeah, and remember, this is a marathon, not a sprint. Be patient, stay focused, and you'll get there. Welcome back, ready to get down to business and turn those concepts into actions.
I'm all for it. Last time we were talking about taking those first steps, actually using Graham's principles. How do we start?
Well, you wouldn't build a house without blueprints, right? Investing's the same. Got to have a solid plan. And to make that plan, you need to know your goals and your risk tolerance.
Okay, so even before I pick stocks, I've got to figure out what I want for my investments.
Exactly. Saving for a house, retirement nest egg, maybe that dream trip around the world. Your goals, they're going to determine your timeline, how much risk you're comfy with, what kind of returns you're after.
It's like knowing where you want to go before packing your bags, right? No bikinis if you're going to Alaska.
That's it. Destination first, then you plan the route. And that's where risk tolerance comes in. How much, bumpiness on the road can you handle? Smooth sailing or a bit of a wild ride?
So if I'm saving for retirement and it's way off in the future, I could maybe deal with a bumpier ride.
Right, because you have time to recover if the market dips. A younger investor, they can handle more risk, maybe put more in stocks, even though stocks can be volatile. But someone closer to retirement might want to play it safer, put more in bonds.
Makes sense. So it's matching your investments to your goals. Okay, so I've got my goals, my risk tolerance. How do I choose what to actually invest in? It's overwhelming.
That's where Graham's idea of fundamental analysis comes in. Really getting to know the value of a business, not just staring at stock prices. Got to dig deeper.
So we're playing detective. Financial statements, earnings, all those details. Try and figure out what the company's actually worth.
Exactly. You're on the case, looking for companies that, consistently make money, have an edge over their competition. Good management, too. Oh, and of course you want to buy them when they're on sale. Remember, margin of safety.
Right. Finding a bargain.
Right.
So good company plus good price.
Mhm.
Is there like a secret formula to find these deals?
There are some tools, yeah, like the price to earnings ratio, the PE ratio, compares a company's stock price to its earnings per share. A lower PE could mean the company's undervalued. Could. It's just one clue, though. You can't just rely on one number. You got to look at the big picture.
So use my brain, not just a calculator.
Got it. You got it. And don't forget diversification. Don't put all your eggs in one basket.
Ah, right. Even if I think one company is like the next big thing,
Yeah.
I shouldn't bet everything on it.
Nope. Diversify, spread your investments around different industries, different parts of the world. It's like insurance for your portfolio.
Protection from those market ups and downs. Okay, starting to feel like I could actually do this.
Yeah.
But there's one thing we got to talk about. Emotions. Mr. Market's got his mood swings, but what about ours? How do we keep them from messing up our investment?
That's huge. That's where Graham's insights into psychology were so sharp. Investing isn't just about numbers, it's about managing yourself.
Taming those inner demons. The fear that makes you sell when everything's down. The greed that makes you chase the hottest stock. Hard to do though, right?
It is. It's a real challenge. Remember what Graham said. The investor's chief problem, and even his worst enemy, is likely to be himself.
Ugh, yeah. We're our own worst enemy sometimes.
Sometimes, yeah. But we can learn. Having that investment plan, writing it down, helps. It's a way to stay disciplined when things get emotional.
Like a set of rules to keep me on the right path.
That's a great way to put it. Rules to help you make logical decisions, not emotional ones.
I like that. Okay, but sometimes these emotions, they feel really strong. What can we do practically to stay calm and avoid doing something dumb?
Focus on the long term. Value investing. It's a marathon, not a sprint. Tune out the day-to-day noise of the market. Look at the bigger picture.
So instead of freaking out over every little change, I should be thinking years ahead.
Exactly. 5 years, 10 years, 20 years down the line. Remember compound interest. It's like that snowball rolling downhill, getting bigger and bigger.
The longer it rolls, the bigger it gets.
That's the power of time. But yeah, it's easy to get distracted, especially these days. Everything's moving so fast. Everyone wants instant results. So how do we stay on track? How do we avoid that hype? Tune out the noise. Mr. Market's always going to be there trying to get you to react. But you don't have to listen.
Like putting on noise-canceling headphones,
Yep.
blocking out the distractions.
That's it. Don't get caught in the frenzy. Stick to your plan, those fundamentals, and let compound interest do its thing.
Okay, I'm feeling empowered now. I can actually control this, not just be controlled by the market. But we all make mistakes, right? Especially when we're learning. What are some of the big ones people make with investing, and how can we avoid them?
Great question. I've made my fair share of mistakes and learned a lot from them. One of the biggest. Letting fear or greed call the shots.
Ah, right. Panic selling when things drop, or jumping on the bandwagon for the hot stock everyone's talking about.
Mr. Market loves those reactions.
Mhm.
But a value investor, they stay cool, they make decisions based on research, not on emotions.
Right. And another common mistake, not diversifying enough. It's tempting to go all in on what you think is the best thing. But what if you're wrong?
Even if I think, like, this company is going to be the next Amazon, don't put everything in it.
Exactly. Spread the risk. Diversification, it's a safety net for your portfolio.
Okay, I see that. We've talked about Warren Buffett. He's like the value investing superstar, right? He learned from Graham, didn't he?
He did. He always credits Graham as like his mentor, calls The Intelligent Investor the best investing book ever. And if you look at Buffett's success, he's clearly put those principles into practice.
So what can we learn from him? How's he adapted Graham's ideas for today's world? That's a great question, one we're going to dig into more in the next part of our deep dive. But for now, think about this quote from Buffett himself. Price is what you pay, value is what you get. What does that mean for value investing?
Ooh, that's good. Definitely going to think on that one. Don't worry, listeners, we'll be back to unpack that quote and really explore, how all this works in the real world.
And remember, the journey of a value investor. It's all about learning, adapting, and growing.
All right, welcome back. It's the final part of our deep dive into the intelligent investor. We've covered so much already. Intrinsic value, margin of safety, keeping her cool when the market goes crazy. But like they say, the real deal is putting all this into practice, right?
Yeah, definitely. Knowing the theory is good, but actually using it to make decisions, that's where the magic happens.
Right. And last time, we ended with that quote from Warren Buffett. Price is what you pay. Value is what you get. What does that really mean for us for value investing?
It's so simple, but it kind of sums up everything. A lot of folks, they're just focused on the price of a stock, watching those numbers go up and down. But a true value investor, they're looking at the business itself, the value of the business.
So a stock price, that can be all over the place, right?
Mhm.
News, rumors, people just like feeling good or bad that day.
Yeah.
But the actual value of a company, that comes from like how much money they're making, what they own, their leadership, that kind of stuff.
Exactly. And sometimes the market gets it wrong. It misprices things. That's where a value investor can step in and find a deal. They're not chasing fads. They're looking for those hidden gems that are priced too low. And they're patient. They can wait for the market to catch up.
That reminds me of what we talked about before, like being a detective.
Yeah.
A value investor does their homework. They don't just follow the crowd.
That's it. And this is where things get really interesting. Because as much as Graham believed in fundamental analysis, he knew the market changes. All the time.
Right. It's a whole different world than when Graham wrote the book. We've got new tech, new industries, even new ways to invest. So how do we use his ideas today? Do they still work?
They do. The key is to understand the spirit of his teaching, the big ideas, the core principles, and then apply those to what's happening now.
So don't just follow the rules blindly. Understand the reasoning behind them.
Right. For example, Graham talked a lot about investing in things you can touch, like factories or real estate. But these days, a company's most valuable stuff might be like their ideas, their brand, their connections. That's hard to touch.
So we got to broaden our idea of what value is. Look beyond just the physical stuff.
Exactly. It's about a company's potential to make money in the future. And that takes a different kind of thinking, considering things like innovation, market share, and, whether people even like their brand.
So we're adding new tools to our investor toolbox.
Hmm.
But the main principles, they're still there. Find undervalued things, manage risk, think long-term.
Yep. But here's the thing. The market never sits still. What worked yesterday might not work tomorrow. That's why Graham stressed how important it is to keep learning. Always be adapting.
So don't just read The Intelligent Investor once and think you're done. Got to keep coming back to it, check if your ideas still make sense.
Exactly. And that margin of safety we talked about, even more important now.
Okay.
Because no matter how much you know, the future's always going to be a bit of a mystery.
Right, that buffer, that cushion,
Mhm.
helps us sleep at night knowing that even if we mess up a little, it's okay.
Exactly. Protection from the unknown. This has been quite a journey, huh? Really digging into The Intelligent Investor. We've not only broken down the book, but I think we've started to see how it fits into today's world, too.
Yeah, definitely. Feeling a lot more confident now, not just about the how-to, but like the whole mindset of it all.
That's great. So for someone just starting out with this whole value investing thing, what's your top piece of advice?
Hmm. Well, echoing what you've said, remember it's a marathon. Patience, discipline, always be learning. That's how you win the long game.
Well said. And to everyone listening, thanks for joining us on this deep dive. Hope you found it helpful. Remember, being an intelligent investor, it's a journey. You keep learning, growing, and building a better financial future for yourself.
And just like Benjamin Graham said, the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go.